mind, looking for a dime. James Locke in the house, gonna help you shine.
Welcome everyone. Welcome to the Poole Locke YouTube channel. I'm James Locke. Today we're going to answer two more Ask James questions of the day. First question is from Robert. So it says the Federal Reserve what are they doing with interest rates, raising them, lower them, but what does it really mean for long-term rates? All right, that's a good question. And it's one that's on the top of the mind for many investors, especially, those planning for retirement. Now you're clearly, tuned into the nuance of interest rate dynamics. So let's explore this further with a focus on income investing and reducing risk. And as you point out, short-term and long-term interest rates don't always move in sync. Traditionally, long-term rates are expected to be higher than short-term rates to compensate investors for locking in their money over a longer period. However, the recent phenomenon of that inverted yield curve, where short-term rates exceed long-term rates, has been notable over the past, couple of years. This inversion raises questions about economic expectations in the Federal Reserve monetary policy. Now, we've gotten it pretty flat now, which is good. But what does it all mean? Well, it largely depends on the economic outlook and how the Fed chooses to respond. If the economy shows strength and inflation remains a concern, the Fed may leave short-term rates unchanged or even raise them. Right now, historically, this would pressure long-term rates upward as well, aligning with economic growth expectations. However, recent trends suggest a different narrative, right? Following consumer price index data and things like that, the yield on the 10-year government bond, has decreased a little, signaling a market response that questions the sustainability of inflation pressure. So some financial institutions, Goldman Sachs, Morgan Stanley, things like that, now they might have different views on the Fed's next move, ranging from deeper cuts in the near term to adjust further down the road. And this uncertainty underscores the complexity of predicting interest rate movements and their impact on long-term rates. Now, for retirees or those nearing retirement, the implications are significant. Locking in long-term rates during periods of uncertainty can be advantageous, especially if you've been primarily exposed to short-term investments thus far. Lower long-term rates may kind of present an opportunity to secure stable income streams without the volatility that can accompany short-term market fluctuations. So ultimately, staying informed about economic indicators and understanding the Federal Reserve's stance on money and monetary policy can help you make informed decisions about your retirement investments. Consider consulting with an income specialist who can tailor strategies to your risk tolerance and income needs, ensuring your portfolio is positioned to weather potential interest rate shifts while generating reliable retirement income. So really kind of in conclusion, while the outlook for long-term rates remains uncertain, staying proactive in your investment approach can help mitigate risks and capitalize on opportunities as they arise in an evolving, ever-evolving economic landscape. So that's a great question. And if you have a question that you would like to send in, you can do so. You can email that question to poollocke@poollocke.com. Moving on. Second question. It's from Nate. It says, if the Federal Reserve, if the interest rates are not going to increase anymore, right? Shouldn't the withdrawal method work better because the value of stocks and bonds will be going up? All right. So your question touches on a crucial aspect of retirement planning, especially in the context of our current interest rate dynamics and market volatility. So let's delve deeper into how the withdrawal method intersects, right, with these considerations, keeping a keen eye on income generation, reducing risk, and reduced volatility. Now, if the Federal Reserve decides to halve, right, or maybe let's just say the Federal Reserve stops it, halts future interest rate increases and doesn't decrease, right? Then there's a potential scenario where the value of stocks and bonds could increase, right? Now, this can certainly be advantageous for retirees who rely on these assets for income. You might feel tempted to withdraw more or take advantage of higher asset values to achieve various financial goals like charitable giving or assisting loved ones, and that's understandable. However, there are important caveats to consider. One significant risk is reinvestment risk. This occurs when bonds or other fixed income investments mature or get called early, and you're forced to reinvest at lower interest rates or lower prevailing rates at that time. This can impact your future income streams if you're relying on consistent returns to fund your retirement lifestyle. So, the strategy of focusing solely on the withdrawal method, taking out funds as assets appreciate, needs to be tempered with a broader perspective. While seeing your portfolio grow in value is reassuring, the primary goal in retirement shouldn't be ensuring a steady, it should be a steady and sustainable income stream. The income stream forms the bedrock of financial security in retirement, allowing you to cover essential expenses and maintain your desired standard of living, regardless of market fluctuations. So in practical terms, as you approach retirement or are already retired, it's crucial to prioritize income generation over total return. This means structuring your portfolio with investments that are geared towards consistent income streams, such as dividend-paying stocks, bonds, perhaps an annuity if they align with your financial goals and risk tolerance. It's also essential to shift your mindset from a total return focus, which may have served you well during your accumulation years, to an income-first approach. While growth and total return are beneficial, they should complement your income strategy rather than overshadow it. So this adjustment really acknowledges the phase of life you're entering, where the reliability of income becomes paramount to sustain your retirement lifestyle. Lastly, always consider the downside. What if the market doesn't perform as expected? What if your income isn't sufficient to cover your needs? Planning for these scenarios ensures you have contingencies in place to safeguard against running out of money prematurely. A situation that, as you rightly pointed out, is one of the worst outcomes in retirement planning. So in conclusion, while the withdrawal method can be viable, especially in favorable market conditions, it's crucial to integrate it with a broader retirement income strategy that prioritizes stability, reduced risk, and reliable income generation. By doing so, you can navigate market fluctuations with greater confidence and ensure your financial security throughout retirement. Two great questions today. If you would like to send in your question, you can do so by emailing that question to Locke@PooleLocke.com. And if you like what you heard, go ahead and like and subscribe to our channel. I'm James Locke, your retirement income source. I'll see you next time.
Money on my mind, looking for a dime. James Locke in the house, gonna help you shine. Retirement is near, don't you live in fear. Listen up, my friend, let me make it clear. Savings in the bank.